New Zealand US dollar. So the first opportunity which was presented was this sell divergence, which I've marked with a red arrow. And if you don't know what that is, you can go back to one of my videos where I explain the strategy, the divergence strategy. So this was a bit of a sell divergence, and then I got in on that trade, but I got tagged out. Obviously, you can see price came back midweek around Wednesday, Thursday. Price came back down, came back up to that area we started the week on, right? So I got tagged out, and then I sold in again, and not because of a divergence, because there was no longer a divergence, but I sold out because there was a double top. So a double top is basically like an M. Think of you drawing a capital M on a piece of paper. This is the first leg, and then price comes down, comes back to retest, and it's a very short-lived relief, and then price falls back down again. And after it's starting to fall, you can use the 8 moving average 1 hour strategy. I can basically explain that to you later on. So this is the 8 moving average. Price started going down. Things were looking good. Things were looking good. And I got out here because I saw the same thing happen here. I saw a double bottom forming here, so I thought we are gonna break out. So once we got here and we're kissing this 89 moving average, I immediately got out. Now the reason why I got out of the 89 moving average is because if you look in the past price usually when it's overextended like this, it comes back down to the 89 moving average. Now, don't just go apply it to every single pair. You have to look at how the pair moves and its characteristics. So essentially, that's what happened. And then Friday, this morning, what happened was uh, this rising wedge formed, this beautiful rising wedge formed. So that was the play for this week. So post this double top, right? This was the week's play. This divergence was trade number one, trade number two for the week. And then Friday, this morning, was this beautiful play here. So I did get in here, right? And then I got tagged out. And then immediately when we touched the support where I put this arrow here, we touched that support and then I got in. Now, the reason why I have multiple trades in is to, number one, cover my spreads for the weekend. Number two, cover out the position that I got tagged out in. And obviously, this is a smaller pair, so obviously I have to trade a bit bigger. So that's why I have multiple positions open. It's because number one, to cover the spreads over the weekends. Number two, it's a smaller pair. Number three, because I got tagged out in the morning, right? So I got in again, and this afternoon we saw a huge push up, and then now it seems like we're gonna go push up again. Now I do trade this with correlated patterns, right? So for example, if I've talked a bit about correlations before though. So obviously if I'm buying the New Zealand US dollar, it would mean that I'm selling the US dollar, right? So the reason why I looked at the New Zealand US dollar was because I was looking at selling the US dollar pair. I'm gonna review that one just now. Markets are still open, but basically for the week ahead, I'm just going to leave this trade to play out. I've hit break even. I've put my stop losses to break even. So even if price does move against me, I'll be taken out for $0 and covered all my spreads. So essentially, if you're buying the New Zealand, obviously you're looking to sell the US dollar. It doesn't make sense for you to be buying the New Zealand US dollar and then also buying a US dollar pair, and then you're also buying US dollar rand or US dollar um which other US dollar franc or US dollar CAD. It doesn't make sense. So we're gonna head into the US dollar review just now. But essentially, this is what a falling wedge looks like in real life. So for me, it's important for you to see what these patterns actually look like when someone is trading them, because it's not enough for you to just see it on a piece of paper and then say there's something called a falling wedge, because a lot of the times there will be accumulation, right? So what that means is that price will range, right? As you can see, price played around from 7 a.m. to around nearly 4 o'clock. The real movement started to happen at 4 o'clock. So this whole time period, there was an accumulation, right? Meaning the price was just trapped there and it was ranging. So a lot of the times you hear you hear analysts saying never trade a ranging pair. But the problem is you never know you're in a range until you're in a range. So you can't avoid that. But what you can do is be aware that, especially with ranges or ranging markets, there's usually price usually um, goes down to tag your stop loss and then goes up. So you need to review your trades and honestly watch what's going on. Because if you had just left your trade here and you just said it's a rising wedge, that's it. You would have been tagged out and then price would have started moving in your direction and you would have lost out. So that's very important. And I don't know if you can, I wouldn't recommend having a huge stop loss because someone will say, why don't you just put a huge stop loss? The problem with that is that you are increasing your risk. If you had said you're risking 1%, if you have a huge stop loss, you end up risking 3%. Rather get tagged out and then get tagged in, right? And then once price probably pulls back, and then before it goes up, add another position or two to cover the position you were tagged out and the spreads from that, rather than setting a huge stop loss. And so, yeah, so accumulation is important. This is a ranging pattern, and that's the reality of it. If you see someone who's showing you a screen and they're like, watch me make, I don't know, 1,000 in 2 hours. Yeah, good luck with that. But usually, what tends to happen is that they wait for this huge push up and they're over leveraged. And the reality is, a pattern can play out for over 2 weeks, a week, and you just have to be patient. So, essentially, the target is where the price fell from. So, for me, here is the target. We fell from this price here, and that's what I'm holding for next week. So next week, that's essentially what I'm looking at, is to hold this position until we touch this area here. And obviously, I'm looking at this pair in correlation with my US dollar trade. If US dollar starts to strengthen, I have no reason to be buying this pair, right? It just makes sense with correlations. If I am selling the US dollar on another pair, and it seems like US dollar is strengthening and I close those US dollar sells, I have no reason to be buying this pair if US dollar is strengthening, right? Um, yeah, so accumulation, being tagged out, it's a very important. And you can't always, that's why it's important to have your risk correct. Rather have like risk zero point 0.5 and get tagged out and then increase after the tag out, right? So this was the perfect entry. I got tagged out in the morning. I think this was before 6 a, around 5, 6 a.m., right? Got in, got tagged out. And then that's when I got in the bigger position because I knew now the stop hunts have taken place, and then now it's time for the big moves. Now, if you trade huge on your first entry is usually wrong. I don't know whether you can say it's broker manipulation or it's just that, um, you know, the markets take time to react. Whatever it is, you should always account for that risk. And then you could have also used the head and shoulders. This did look a bit like a head and shoulders pattern, this being the left shoulder, this being the head all the way down here. Then once price came down here, you could have bought thinking it's a head and shoulders. So there's no right or wrong answer. You could have also used patterns or pin bars. You could have also looked at the pin bars and said this is an upside down hammer. Price is about to push up, and basically that's all waiting for next week. So obviously, if the US dollar continues to weaken next week, I'm going to be holding this position for the long haul while we wait for the US dollar to continue to weaken.